Our next guest says the United States and Europe will outperform emerging markets this year. Marc Faber is the editor and publisher of the Gloom, Doom, and Boom Report. He joins us right now on the Squawk Newsline from Thailand. And, Marc, it's great to talk to you this morning.
Yes, my pleasure.
You know, we have President Hu Jintao visiting Washington today, and U.S. business leaders are lining up to welcome him. But it's the Asian markets that have been performing so well as we watch this visit approaching, with many of those markets at their highest levels in 2.5 years. Why is it that you think that the U.S. and Europe will outperform some of those Asian markets?
Well, I think precisely because the emerging economies have performed so well over the last 18 months. In other words, since the March 2009 lows, I believe that the U.S. and Europe has a better chance than the emerging markets that have become, I wouldn't say necessarily very expensive, but certainly not great values anymore.
And
there are exceptions to that. And also, my concern is this. We have money printing around the world, and in particular in the U.S., and that has led to very high food inflation and inflation in energy prices. And in low-income countries like China, India, Vietnam, and so forth, energy and food accounts for a much larger portion of personal disposable incomes than in the United States. So these countries are suffering basically from high inflation, and that reduces the purchasing power of people. So I think that the monetary authorities in emerging economies will have to tighten, or they have to let inflation accelerate, both of which are not particularly good for equities.
So do you think President Hu could convince the United States or the Federal Reserve to try and take it a little bit easy when it comes to QE2? Is that going to be his main mission here?
I don't think so. There are much more important issues. We have in the world still a superpower, the U.S., and we have a rising power. This is China. And China wants to have a greater say in global affairs. They basically dislike the fact that Americans have naval and military bases in Asia and still control parts of the waterways, which are very crucial for China for the shipment of oil from the Middle East. And there is still North Korea, the North Korean issue. It's not widely talked about, but it's a fact that without China, North Korea wouldn't exist. And North Korea exports nuclear technology to all kinds of countries that are essentially hostile to the United States. So these are the big issues. In addition to that, the U.S. would like China to let their currency appreciate at a faster rate, and China would like to have more access to U.S. technology.
You know, you mentioned how you think the higher oil prices are putting a bigger crimp on Chinese consumers than American consumers, relatively speaking. But you do think oil prices are going to continue to climb, correct?
Well, looking at the dynamics of the oil market, I think to be invested in oil is quite desirable for two reasons. First of all, if the optimists are right, and we have a global economic recovery, and it would appear for the time being to be the case, because during the crisis of 2008 and 2009, oil consumption in the developed world went down, but in emerging economies it continued to go up. But now, in the developed world, it's picking up, so total global oil consumption is rising, and I think that will put pressure on oil prices. But if you believe in a horror scenario, which eventually brings about high inflation and then war, then oil is also desirable because it will lead to interruptions in the supply of oil. So in either case, either you're very bullish or very bearish, you should own some oil or energy equities.
All right. Marc, we want to thank you for calling in today, and we hope to talk to you again soon.
Thank you very much for having me on your program.
Okay.